All right. Hi guys. I hope the audio and video is clear. Let's get started and revise our portfolio risk and return part two that was left. Now the agenda again to understand. I'll again repeat. I've repeated this several times, guys. We are doing a revision lecture. So obviously, I'm not going to get into detail of things, especially with respect to this chapter. I will be giving up straight up facts that are required for your exam. And if you remember this, you're sorted for the exam. That is what is my effort. That is what my agenda is going to be with respect to whatever we are going to spend the next 1.5 hours with respect to this lecture. All right, without wasting any time, let's get started. Let us understand that whenever you combine a risk-free asset with a portfolio of risky assets, what happened with respect to the standard deviation of the portfolio. Whenever we combine a risk-free asset like a treasury bills with a risk-free asset with a risky portfolio. This is very important to understand. So the first part which you see in Schwezer, the first LOS, where it is talking about combining a risk-free asset with something which is risky, we are talking about a portfolio of risky assets. Remember this, right? And you must have studied this in previous chapter as well, which is portfolio risk and return, where you were doing the same thing. You were combining the two, right? And you can clearly see the diagram represents the same thing, right? We are somewhere at this point. This is your risky portfolio. This point is your risk-free asset, right? This is what it is. Now, if your portfolio is somewhere here, that means the weight of risk-free asset might be, let's say, 50%, and the weight of risky portfolio might be 50%, right? If you're somewhere here, then the weight of risky portfolio might be 80%, and the weight of risk-free asset might be what? Might be 20%. If you are at this point, then the weight of risky portfolio is 100%. And if you're at this point, the weight of risk-free asset is 100%. It is very, very important to understand this. You would have studied this in the previous chapter as well. All right. So that's how the plotting is done. Sir, we do understand this with respect to plotting. Sir, what was this line called? We do remember this line. It was called as CAL, which is capital allocation line. I hope you guys remember this, right? That is what this was. Now, if your portfolio is somewhere at this point, then the expected return of the portfolio is going to be somewhere at this point, and what the standard deviation of the portfolio is going to be is going to be somewhere at this point, right? You know what? Whenever you combine a risky portfolio with a risk-free asset, what happens to the overall portfolio standard deviation is what we have to learn right now. Okay, so sir, are you talking about the standard deviation of portfolio, a portfolio that combines risky portfolio and what? A risk-free asset. That is what is that the portfolio that you are referring to? Yes. The standard deviation of such portfolio would be what? Would be what, sir? We know here actually there should be square root. It should be weight of A, which is the risky portfolio square into standard deviation of risky portfolio square. If I were to continue using A means risky portfolio. So where your A is equal to risky portfolio plus what is B? Sir, B would be your risk-free asset. So weight of B square plus into, sorry, standard deviation of B square, where B is equal to risk-free asset plus 2 into weight of A into weight of B into what? Weight of A into weight of B. I hope you guys remember the formula, or where you are investing in a portfolio which consists of two assets, and how do you find out the standard deviation of that portfolio? 2 into weight of A into weight of B into correlation between A and B into what? Standard deviation of A into standard deviation of B. Now we didn't have this place, that's why I've written it right here, right? Remember, guys, the standard deviation of a risk-free asset is always equal to zero. So this win itself will become zero, and this entire third term will also become zero because you're multiplying with something that is zero. Also, one more thing. If you guys remember, I don't know if you guys remember or not, but the correlation between a risky portfolio and a risk-free asset is equal to zero. That means there is no correlation at all. There is no correlation at all. So this terms become zero, this terms become zero. So if I have to find out the standard deviation of such a portfolio, which consists of risk-free asset and a risky portfolio, the standard deviation would be simply this. And if I simplify this further, it would be simply weight of A into standard deviation of A. That means a portfolio that is combining risk-free asset and a risky portfolio, the standard deviation of such portfolio is simply the weight of risky asset portfolio in that portfolio into the standard deviation of risky asset. Now I am using portfolio twice. I hope you guys understand. My portfolio is created of a risky asset portfolio and a risk-free asset. So the standard deviation of such a portfolio will be what? Will be simply the weight of the risky portfolio in my entire portfolio into standard deviation of risky portfolio. Simple as that. And that is what your first LOS is. Simple. That is all you need to remember, nothing else. Obviously, the expected return of such portfolio will be what? Sir, we know how to find out expected return from the previous lecture. We do understand this of portfolio risk and return part one, that it is simply the weighted average of the constituents in the portfolio. And we have done a portfolio only of two securities. Right? So simply you have to just take the weighted average, and we've done that so far. So again, pretty simple and easy to understand concept. The challenge starts from here. The challenge starts from here. Sir, what is, I mean, we're very confused a lot of times. Sir, what is CAL? What is, CML? What is SML? Sir, there is one more concept which is security characteristic line. Sir, there are so many things that are happening in and around. Sir, it's very difficult for us to differentiate. Let us understand each and every line, if I were to put it in a very simple way, in a very, very crisp and precise manner. First, let us understand what do you mean by capital allocation line. Sir, we already understand this. Capital allocation line is a line that plots different combination of a portfolio that consists of a risky asset portfolio and what? A risk-free asset. That is what CAL is. So we understand that. It consists of a combination of risky asset portfolio and what? A risk-free asset. Okay, sir, fair enough. We do understand that it consists of combination of a risky asset portfolio and a risk-free asset. Sir, what is going to be the equation of this line? The equation of this line is pretty simple. Cal, which plots and again repeat the different combination of a risky asset portfolio and a risk-free asset. The equation of this line is given by simply risk-free asset plus the expected return on the risky portfolio. Just hold on for a second, guys. Expected return on the risky portfolio minus the risk-free return divided by standard deviation of the risky portfolio into what? Standard deviation of the portfolio. I hope you guys are able to differentiate very, very well between standard deviation of a risky portfolio and standard deviation of the whole portfolio. Right? My portfolio consists of two things: risky asset portfolio and risk-free asset. So here I am using the standard deviation of risky asset portfolio multiplied by the standard deviation of entire portfolio, the one that we just found out. So how did we find that out? How did we find it out? The calculation that we just did, this one, which gave us the standard deviation of the portfolio. Right. And sir, if you carefully notice this, you will understand that the equation of the line CAL, this is your CAL, capital allocation line. Why is it called as capital allocation line? I've repeated that multiple times. I hope you guys remember this. The equation of CAL will be given, or this what we have just spoken about, will be given by risk-free rate. I'm again repeating, risk-free rate plus expected return on the risky asset portfolio minus risk-free asset divided by standard deviation of risky asset portfolio into standard deviation of portfolio, which is the combined portfolio. This is nothing but equation of line. Y is equal to what? AX plus B. It is given by that only. This is equation of line, where this is your what intercept? This is your y-intercept, and this is your slope. This is your slope. So it is nothing but the equation of line. So how did we arrive at this equation? Sir, we do understand cal. We understand that the cal plots different combination of risk-free asset portfolio, sorry, risk-free asset and risky asset portfolio. Sir, the equation of this line is given by the equation of this line cal is given by the normal equation of line, which is y is equal to ax plus b, where there is a y-intercept, where there is a slope, where there is whatever is on the x axis. Okay, sir, we do understand that. So we do understand cal a little. And this is what the formula is, and this is the different ways where the different parts of the formulas have been defined. And key interpretation is what is y-intercept, what is slope, and all of those things have been sort of defined here. Right. And what do you mean by slope? This slope measures the steepness of a line, right? Steeper the line, higher will be the slope. Flatter the line, lower will be the slope, right? So this line would have very less slope as opposed to this line. This is a steeper line, right? So the slope will be a lot more. Slope is this. It measures this, right? Sir, now we are talking about cal. Sir, what if there are multiple cals? Is that possible? Yes, very well possible. I talk about an individual investor. Let's take an example of me. I would have different cals because cal plots what? Combination of risky asset portfolio and a risk-free asset. Can I say there can be multiple portfolios that are possible? Yes, sir. Portfolio A, which is a risky asset portfolio. Portfolio B, which is a risky asset portfolio. Portfolio C, which is a risky asset portfolio. There are multiple risky asset portfolios that are possible. I hope you guys understand this. Okay, sir, fair enough. There are multiple risky asset portfolios that are possible, but risk-free asset to remains here only. Fair enough. And I hope you guys, I don't have to repeat this again and again. On y-axis, you plot the expected return. On an x-axis, you plot standard deviation, which is the total risk. Systematic plus unsystematic, both. Total risk is what you talk about here, right? So now, when you plot multiple cals, which is the best cal for an investor like me? अरे यार सर नहीं समझ आ रहा आपने क्या बोला अभी वापस एक बार रिपीट करते हैं लेट अस ट्राई टू रिपीट दैट देयर आर मल्टीपल रिस्की एसेट पोर्टफोलियोज दैट आर पॉसिबल एग्जांपल रिस्की एसेट पोर्टफोलियो ए रिस्की एसेट पोर्टफोलियो बी रिस्की एसेट पोर्टफोलियो सी okay sir now cal a if I talk about this cal this plots multiple combination of weights that are possible with respect to investment in risk free asset and risky asset portfolio a. Cal B plots multiple combinations of weights that can be possible to invest that are possible which you can invest in risky asset portfolio B and risk free asset. And same goes for Cal C. All right, for Cal C. Oh, that sort of rhymed. But what I'm trying to tell you guys is there are multiple Cals that are possible. For an individual investor like me, which is the best Cal? The one that coincides, the one that is tangent to my indifference curve, because that's where I will get maximum utility. So this is the Cal that is the best Cal for me. This is the Cal that is the best Cal for me. All right, so we do get that this is the best Cal for you. Uh, okay, fair enough. And you can clearly see this will have the highest slope. This Cal will have the highest slope. What is slope? It measures this line is more steep. There is more slope, steepness. There is lesser slope in this lesser, and the least slope is in C. Right. The best Cal is the one with the highest slope. And what will be the best portfolio here for you to be invested in? Which one is going to be the best combination? Sir, Cal A is the best Cal for us. We do understand. But which one is the best portfolio for us? The one that is tangent. So we will somewhere be here, which might be, let's say, 60% in risky asset portfolio A and 40% in risk-free asset. Okay, sir, ये तो easy है, sir. समझ में आ रहा है कुछ नया तो नहीं है. This is nothing else. But one thing that you guys should note that a risk averse investor, what? A risk averse investor, obviously, in any sort of cal, whichever is tangent to his indifference curve, would want to, or if I were to talk in simple ways, let me just sort of put it, for a risk averse investor, the indifference curve would look something like this, which is more sort of flat, which is less steep. And it makes sense that indifference curve for a risk averse investor will somewhere be at the bottom and he would want more invested in risk free asset. because for this type of investor, the risk-free asset investment would be less. But for this type of investor, the risk-free asset investment would be more. And you can clearly see as the point of tangency is right here. And if you are at this point, obviously risk-free asset is more closer. That means there is more weight in risk-free asset as opposed to risky asset. But at this point, there is lesser weight in risk-free asset and more weight in portfolio A, which is risky asset portfolio A. And I hope you guys understand. And if you guys remember from the previous lecture, portfolio risk and return part one, there were two indifference curves and there was a cal. And two indifference curve were for two different type of investors, risk averse and risk seeking. A risk seeking investor would be having indifference curve somewhere here because he would want more. He's a risk seeking investor. He would want more risk. I mean, he would enjoy taking more risk, and he would be okay with lesser return being compensated to him for more risk. But risk averse investor would say that if I'm taking more risk, I would want more return for it. And you can clearly see by the shape of it as well, right? As the risk increases, this person would want more return. But for this person, as the risk increases, the relative amount of return that he would want would be less, right? So this is again the repetition of what we did the last time. So sir, cal तो कितनी बार पढ़ लिया, वापस क्या पढ़ा रहे हो? It is very important to understand that cal is the base of CML, which is capital market line, which is the what? The base of something which is called as capital market line. I'll again repeat what do you mean by cal, sir? Cal plots the different combination of risky asset portfolio and what risk-free asset that we invest as a portfolio. A portfolio consists of here risk-free asset and what risky asset portfolio. All right, sir, fair enough. We do understand. It is given by this equation. All right, sir, fair enough. Sir, whatever the cal is, the equation of that cal line is given by what, sir? It is given by the equation of line simply y is equal to ax plus b. Sir, y is equal to ax plus b. It consists of y-intercept and also the slope. Okay, sir, fair enough. We do understand that. If you don't understand y-intercept and slope right now mathematically, don't learn this equation. Simple as that. All right, sir. If we move forward, all right, fair enough, sir. If we move forward, there's a part in Ashwezer where they have multiple cals for an investor. So if I talk about myself, there are multiple cals that I have: cal A, cal B, cal C. Why is that so? Because there are multiple risky asset portfolios that are possible, right? There's portfolio A, B, C. Cal A plots the different combination of weights of portfolio A and risk-free asset. What? Portfolio A and risk-free asset. Cal B plots different combination of weights of risk-free asset and portfolio B. And same goes for cal C. Now, for as an individual investor, which is the best cal for me? The one that is tangent to my indifference curve. Okay, sir, fair enough. We do understand that fact. It is the most whatever is the most whichever is like the tangent to my cal. Sorry, guys. Whichever indifference curve is tangent to my cal, that is what I would go for. In revision, you have to sort of speak faster, so you sometimes lose rhythm. Anyway, yeah. So the one that is tangent, you sort of that is what is going to be the indifference curve for you. All right, sir, fair enough. The one that is tangent is going to be the indifference curve for us. I mean, sorry. Hold on. Yeah. What I was saying, guys, is the cal for me is going to be the one that is tangent to my indifference curve. So here cal A is going to be, just hold on for a second. Yeah, sorry, I'm sort of visiting home, so there's a lot of background this thing. Anyway, coming back to what I was saying, guys, which one is the best cal for me? The one that is tangent to my indifference curve, because that's where my maximum utility is going to be. All right, so this is where my maximum utility is going to be, which is going to be cal A. All right, sir, for an indifference curve like this, which is going to be the best portfolio? The one that is exactly tangent to my cal, this is going to be the best portfolio for me. All right, sir, fair enough. Okay, sir, this is the indifference curve for somebody who's a risk-seeking investor. Somebody who is a risk-averse investor would slightly have what do you call an indifference curve which is slightly a little more steep. All right, sir, fair enough. So obviously, the person who is a risk-seeking investor would have a cal that is sorry, will have an indifference curve that is a little less steep. But for a person who is or for an investor who is not that risk-seeking, is risk-averse, would have a little steeper what do you call indifference curve. Hence, his tangency point with respect to cal A would be a little lower at the bottom. That means that his allocation in the portfolio is going to be much more in terms of risk-free asset, because you can clearly see at this point, sir, the risk-free asset is way more than the risky asset portfolio. And at this point, the risky asset portfolio is way more than the risk-free asset. The point is that the indifference curve will differ for different type of investor. For an investor who's risk-averse investor, the indifference curve would be a slightly steeper indifference curve, which you can see at the bottom. And for a risk-seeking investor, Yield difference curve would be slightly more flat, which you can see at the top. That is why the tangency point that they will have with respect to Cal A would differ, ultimately making their portfolio weights justified as per their risk taking capability. तो अगर मैं बात करूं, investor who's risk seeking would have somewhere like this as a tangency portfolio, and this is the best portfolio for him to be invested in. And you can clearly see the weight of risk-free asset is less. And for a risk-averse investor, this is what the point is where he should invest. This is the portfolio that he should invest in. Ideally, for him, the tangency point is way at the bottom. That means risk-free asset is more, and that just shows that he's a risk-averse investor. All right, sir, we do understand Cal completely. Now, what about CML, capital market line? The problem is now, if I have to give a theory, if I have to give something which is a common conclusion, what becomes a problem? The investor's heterogeneity becomes a problem. Every investor now will have different expectations because your return expectation will be different. Your correlation expectation would be different. Your standard deviation expectation would be different. Your covariance expectation would be different. That means this will differ a lot for every individual. But if I have to give theory, I have to bring commonality. If I have to give certain conclusions, I have to bring commonality. Understand this. Example, perfect competition. When I say talk about perfect competition, I sort of have certain assumptions that are there so that I can justify the theory of perfect competition. If I'm talking about something that's oligopolistic, there are certain theories there are certain assumptions that I'm going to give so that I can justify that theory. Exactly like that, because of the possibility that there can be thousands and lakhs and crores of CALs, because every individual will have a different expectations of return, will have a different standard deviation. What do? I have to give certain standard assumptions. That means I will have same expectations of returns. That means what is the expectation of return from a particular stock, from a particular portfolio, from a particular risk-free asset is the same for you, is the same for me. Our expectation with respect to risk is also the same. Our expectation with respect to correlation is also the same. Understand this very, very well, guys. Understand this very, very well. When I talk about CML, which is capital market line, it is a theory that originates from Cal. So Cal is ultimately the founding theory for CML. And CML is more standardized, is something that is more, what do you call, universal, which applies to a lot of people. That's why I have to have certain assumptions that apply, that are standard, that sort of simplifies things and gives a proper universal conclusions. Fair enough, sir. That is what it is. We understand that CML is ultimately originating from Cal. Okay, fair enough. Sir, that means the expectation of returns for you, for me, the expectation of standard deviation, the expectation of correlation, everything remains the same. Okay, fair enough, sir. Everything remains the same, but one thing that is different, our risk-taking capability, and that still remains. This CML as a theory doesn't tell you that everyone is a risk-seeking individual, everyone is a risk-averse individual. No, it is telling you that risk of a security is the same for everyone. That means the standard deviation of a particular security might be, let's say, 10% for you, 10%, it is 10%, it might be not, it is 10% for you, it is 10% for me, it is 10% for everyone. But the risk aversion coefficient might be different. It is not talking about risk aversion coefficient, it talks about risk of an individual security, of a portfolio, of a risk-free asset being the same, and not about the risk aversion. Understand this very, very well. And a lot of students are still confused till the very end about this. उनको पता ही नहीं होता है कि CML के assumptions क्या है. The assumption is very, very simple, that the expected return from a particular is the same, the correlation is the same. That means what? We all will have the same efficient frontier. Your efficient frontier, my efficient frontier, everyone's efficient frontier will be the same. That means what? The optimal portfolio is also the same. Meaning, earlier what was happening? Earlier, because of different individuals having different expectations, so let's say this is different CALs or different portfolios, this is for me as individual Shreyash. Now for investor X, different CALs might be there, hence his optimal portfolio, this is the optimal portfolio, might be different. For, let's say, investor Z, the optimal portfolio might be different. For investor U, the optimal portfolio might be different. Okay, sir, fair enough, we do get it. But now everyone will have the same optimal portfolio. Okay, sir, same optimal portfolio. What does that mean? everyone will have the same CALs. Okay, sir, why everyone will have the same CALs? Because our portfolios are the same. That means portfolio A, let's say for example, for investor portfolio A, investor X portfolio A, and for Shreyash, investor, Shreyash as an investor, portfolio A earlier was different because their return expectation, their risk expectation were different. So this A and this A was different. But right now, for all of us, A is the same. For all of us, B is the same. For all of us, C is the same. Understand this, very, very important. Guys, are you guys following this so far? That what exactly is the difference between CML and CAL and why exactly CML came into origin? I mean, how exactly it came into origin? Like the kind of assumptions that are required for us to be proving what we're trying to prove. Understanding this, yes or no? With me so far? Yeah, will be steeper. No, for high risk averse investor. Yes, it will be steeper. Yes. For risk seeking investor, it will be flatter. Guys, so far with me, yes or no, quickly, so that we can move forward and understand the rest of the CML. The portfolio A, investor X portfolio A, portfolio Shreyash, investor A, compare those two. Because the return expectation, the risk expectation is different. So this A and this A. All right, sir. Fair enough. Let's move forward. Now, out of the multiple CALs that are possible, this is CAL A, CAL B, CAL C, CAL D, whatever that may be. Which one is going to be the best CAL for me? The one that lies on the efficient frontier. Very, very important. The one that lies on the efficient frontier is the best CAL for me. The one that lies on the efficient frontier is the best CAL for me. So for me, matlab for every investor, because all of our CALs are the same. CAL A, CAL B, CAL C, CAL D. Sir, but earlier you were talking about the best CAL being the one that is on indifference curve. Okay, fair enough. Right now you're talking about the best CAL being the one that is on efficient frontier? Yes. Understand this. In CAL, out of the multiple CALs that we were doing earlier, this the one that CAL basically. What I'm trying to tell you guys is the earlier thing that we were doing. In that, the best CAL was the one that was tangent to indifference curve. In CML, the best CAL is going to be the one that is on the efficient frontier. And I hope you guys understand something that is on the efficient frontier. The upper, the upper part is obviously the best, right? What happened? My razor is not working. Anyway, so this is going to be the best CAL. All right, sir, fair enough. And which portfolio should we choose? The one that is tangent. The one that is tangent. So out of the efficient frontier, on the efficient frontier, there are multiple portfolios that are there. This is a portfolio, 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 this is a portfolio. Which portfolio to choose? Sir, this one. The one that is tangent to our CAL. So which portfolio do I choose? The one that is tangent to our CAL. And you know what? That portfolio is also called as market portfolio, because it is a portfolio that is an ideal portfolio for everyone, and that's why it is called as market portfolio. Simple as that. Right now, all you need to remember is that. All right, sir, fair enough. That is what it is. We do understand that. Sir, but at what point should we be in terms of the CAL? in terms of the market portfolio, sir, we don't understand that, sir. At what point should we be? What does that mean? Also, we also need to understand that. Sir, basically, this is my expected return. This is my standard deviation. Okay, fair enough. Sir, this is the portfolio which is the ideal portfolio, which is the portfolio that should be chosen out of the entire efficient portfolio, efficient frontier portfolios. Okay, fair enough. We do understand that. And one more thing, I forgot to mention, this cal will be called as CML capital market line, because this is the line which talks about plotting multiple combinations of a portfolio with respect to weights in market portfolio and risk-free asset. Now, at what point you should be on this CML will depend upon your indifference curve. If it is somewhere here, then this is what the point is for you. If you are somewhere here, then this is what the point is for you. So, sir, what exactly is CML, sir? Can you please explain? CML, first things first, the biggest problem in Cal was every investor would have a heterogeneous expectation about risk, about standard deviation, about standard deviation, about expected return, about correlation, etc., etc. So, what came into picture? Something that was more universal, CML came into picture, which assumed that every investor will have the same expectation of return, of risk, of correlation. Obviously, now that doesn't mean that they will have the same level of risk aversion. Understand this very, very well. All right, sir, fair enough. Sir, out of the multiple CALs which are going to be the same for everyone, which one is the best? The one that is going to be the tangent to the efficient frontier. Because efficient frontier consists of the portfolios that are the best. So out of the best portfolios, which is the best for us? So first things first, understand that every investor, because they have homogeneous expectation, this is the universe of portfolios and stock, right? Out of this universe, which universe you would want to be? Now, for all the investors, this universe is the same. Everything is the same. Which portfolio would want to be? Sir, obviously, you would want to be in a portfolio which is on the efficient frontier. We would want to be on an efficient portfolio that is on the efficient frontier. Now, on the efficient frontier, we would want to be, obviously, out of that, which portfolio to choose? Because on efficient frontier also there are multiple portfolios. Are the one that is tangent to my cal. The moment I choose that portfolio, the question remains that okay, you've chosen this portfolio. This is a cal that ultimately plots a different combination of a portfolio in terms of weights in risky asset portfolio and risk-free asset. Okay, sir, this cal will be called as CML. Okay, but at which point I should be? I should be the point. I should be at the point as an investor according to my indifference curve. So my indifference curve is somewhere here, then here. If my indifference curve is somewhere here, then here. The point is CML is that cal that plots different combination of weights with respect to market portfolio and risk-free asset. And why do you call that market portfolio? Because it is a portfolio that is going to be used by everyone. It's the most efficient one. Right. All right, sir, fair enough. And this is some theory with respect to that. An equation is all talking about, sir. In case of Cal, the equation is going to be the expected return on the portfolio is the risk-free rate. It's the same. The equation of CML is going to be the same, sir. What is the difference? It is going to be y is equal to ax plus b. Simple equation of line. Sir, okay, this is going to be the y-intercept. This is going to be the y-intercept, the risk-free rate. Earlier, we were taking the expected return on the risky asset portfolio. Here, the risky asset portfolio is the market portfolio. So we take expected return on the market portfolio minus the risk-free minus the risk-free return divided by the standard deviation of the market portfolio. Earlier, we were taking the standard deviation of risky asset portfolio. That is your market portfolio. That is what we will take into standard deviation of the entire portfolio. That is what you will do. Simple as that, nothing else. And that's what wraps up your CML as a concept. So cal is what? Cal is different for every individual. CML is something that ultimately assumes that all of us have same expectations. Sir, when we have multiple cals, the one that is tangent to the efficient frontier will give us the best portfolio, and that line will be called as CML because that line plots the multiple combination with respect to the risky asset portfolio, which is the market portfolio, and the risk-free asset. And that is what your CML as a concept is, nothing else. You don't need to remember. All right. Now, obviously, if you are in that, this is your, let's say, CML, or this is your CAL. This plots multiple combinations that are possible, which you can invest in a risky asset portfolio and a risk-free asset, where you are here 100% into the risky asset portfolio or market portfolio, depending upon you're in CAL or CML, and this is going to be your risk-free asset. All at fair enough, sir. This is your 100%, right? Below this point, obviously you would have invested some percentage in risk-free asset. At this point, probably 10%, at this point, probably 20, at this point, 30, at this point, 40, at this point, 50, I know. As you go down, the weight of risk-free asset basically increases in your portfolio. All right, sir, fair enough. The weight of risky asset portfolio or risk-free asset increases in our portfolio. We do get that. That means these kind of portfolios below this point are called as what? Lending portfolios, because you're lending some or the other money in the form of investment in risk-free asset. Because when you invest in risk-free asset, you invest in treasury bills, and treasury bills are government bonds. And when you give money to government, it is ultimately lending the money. But if you go beyond this point, sir, can I say the weight here will be 110%? Yes, the weight here will be more than 100% in the market portfolio or risk-free asset portfolio. Sir, how come 110%? Can we invest more than 100%? Yes, always. You can invest more than 100%. How come, let's say 110% is your weight, where in risky asset portfolio and where, or basically in risky asset portfolio or your market portfolio, that means 10% you have additionally borrowed and invested. 100% is from your own pocket, 10% is borrowed. And as you go more towards the right, the amount of borrowing keeps on going up. So this diagram is made with respect to what? With respect to assuming that you can borrow and lend at risk-free rate. Sir, lend at risk-free rate, we understand this from this part. Borrow at risk-free rate, this is what this part is. Here, 125% is your weight in what? In the market portfolio or risky asset portfolio, depending upon whether you are in CAL or CML. Right? Here you are 125%. That means 100% is from own pocket, 25% is borrowed at risk-free rate. That's why anything beyond this point are called as borrowing portfolios, because you've borrowed some money and invested. Where? In a risky asset portfolio or market portfolio. All right, sir, fair enough. Everyone with me, understanding everything, understanding CAL completely, understanding how CML is something that is originated from CAL, but with homogeneous expectation, and ultimately what are lending portfolios and what are borrowing portfolios. It's a common concept for both CAL and CML. With me, guys, so far, yes or no? All right, let's move forward now, guys. What do you mean by systematic risk? What do you mean by unsystematic risk? Sir, systematic risk is the risk that is something that cannot be diversified. Unsystematic risk is something that can be diversified away. But sir, what do you mean by total risk? Total risk is equal to systematic risk plus unsystematic risk. Systematic risk is something that is undiversifiable. You cannot diversify it. It is also called as market risk, something that comes from participating in the market, right? An economic crisis, that's something that is not in your hand, that affects everyone, is an example of systematic risk. Tomorrow, interest rate changes, that is also going to impact everyone. That's something that is not that is going to basically affect everyone who's participating in the market. A war happens, going to affect everything in the market. Right? It is also called as non-diversifiable risk. That means via diversification, you cannot eliminate this risk. Meaning, let's say, for example, Ola, if you invest in Ola, the biggest problem currently with Ola is the complaints with respect to its vehicles. This is a company specific risk. It is not a risk with EV as a segment. How can you diversify this risk? You can diversify this risk by investing into another company which is doing well in EV space. So tomorrow the losses of Ola can be covered by that company which is going up, which is doing well in EV space. This is a company specific risk. This is diversifiable. But tomorrow a regulatory announcement comes that EV is no longer accepted as a valid, is basically banned. It's a systematic risk which is going to affect Ola, that other electronic vehicle company. It is going to affect everyone. That is something that is systematic risk. Right. Political instability, recession, global events, all of this. Right. These are the examples. And like again, few more examples have been written down, but I think you guys would understand that very, very well. So what do you mean by unsystematic risk? The risk that can be diversified. Ola's specific risk, unique risk, idiosyncratic risk, firm specific risk. All of these are the examples of it. It can be because of no, something that's a problem with your business. So product recalls. If you guys know this or not, I don't know. If whether you guys were born or not, but like a huge chunk of one of the phones of BlackBerry was called back. There was a recall. If you guys remember BlackBerry, BBM, BlackBerry Messenger, and all of those things. So a huge chunk was recalled. That's a huge risk with respect to BlackBerry only. That didn't make smartphone as a market bad, right? Strikes, poor management decisions, all of these things. Financial risks are also there. Liquidity problems are there. Debts are very high. Industry risk. The new competitors have come in the industry. There are changes in industry regulation and stuff like that. Right. A fire at Toyota plant will affect Toyota shares only, but not the overall market because it's a specific company specific risk. Right. And if you have a well diversified portfolio, if you have a portfolio that is very well diversified, that means unsystematic risk is zero. That means what? Unsystematic risk is zero. Right. Sir, as the number of securities in my portfolio. So if I'm at this point, let's say if I'm at this point, this is the amount of systematic risk I am facing. And this is the amount of unsystematic risk I'm facing. Let me just use a different color pen for you guys so that you guys are able to understand. As the number of securities in my portfolio increases, what happens? Diversification comes in. Systematic risk is not eliminated via diversification. Understand this. The more you buy, the more diversification you achieve. More buy, more diversification. But more diversification doesn't eliminate the systematic risk. The systematic risk remains the same. But the more you buy, the higher the diversification. Unsystematic risk, as you guys can clearly see, keeps on declining. It keeps on declining. It keeps on going down. See right here? Keeps going down, 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 keeps going down. And at a point, it is completely eliminated. That means we are at this point where the portfolio is completely diversified. And it is usually said that at that point is 30 shares, that if you buy 30 shares or 30 stocks, that means you have achieved complete diversification. But it is something that is just theoretical. I think no meaning to it. So I would not stress a lot on this point. And understand earlier when you are diversifying, what happens? Your unsystematic risk starts to decline rapidly. You can see you have increased. This is the amount of shares that have been increased in your portfolio. See, there's a massive decline in unsystematic risk. This is the amount of securities that you have increased in your portfolio. There's slightly a little lesser fall in unsystematic risk. Beyond a point of time, the same amount of securities, even if you increase, the amount of fall in unsystematic risk start to decline. It's like marginal, what if you guys remember marginal utility? The more you have, the lesser benefit you will have. Exactly like that. Right. And that is what this is trying to talk to you guys about. So far, with me, guys, we have understood three topics so far. So we have understood CAL, we have understood CML, and we have understood systematic risk and unsystematic risk. With me so far, yes or no, so that we can quickly proceed. All right, fair enough. Let's move forward, guys. Let us understand, what do you mean by return generating models? What do you mean by what? Return generating models. Sir, what are return generating models? They explain the sources of return. Meaning, my security is earning 12% return. What are the sources of this return? What is the reason for this return? Example, you have done very well in your CFA level 1 exam. You were able to get a score which is way above than majority of the people who sort of gave the exam. What is the reason for it? It can be being disciplined. It can be understanding the concepts well. It can be, a lot of practice. These are the sources which have made you clear the exam. Exactly like that, a stock has earned 12% return. What is the cause or source of that return? It can be because a stock is small cap in size. Because it's small cap in size, and small cap stocks generally tend to outperform mid cap stocks in the longer run. That's why this stock has ultimately earned more because it's a small cap stock. Example I'm giving. So return generating model gives us possible explanation of what exactly is the cause of, or what are the sources of return for this. Once you study that in the past and understand what are the sources of return, can I say you can predict in the future that these are the factors that will influence the return of the stock. It can be economic factors, it can be market factors, it can be anything. The return generating model help you study the sources of the returns that have come, that have ultimately impacted the stock, and ultimately will help you predict that what are the different factors that will ultimately influence the return of the stock. And the moment you understand different factors that will influence the return of the stock, what are you going to get? You will get the expected return of the stock. Return generating model आपको सीधा पढ़ा दिया है that they are giving you expected return of the stock, but they are not giving you this entire background that listen, when you start or when you make a return generating model, that ultimately studies in the past that what are the sources of return of this particular stock. The one stock, security, whatever that may be, the moment you have the sources of return of a particular stock, what happens? You can predict that these are the factors that affect the returns of this particular stock. In the future, the moment you predict the what are the different factors that are affecting the returns of the stock, what can you do? You can ultimately predict the expected return of the stock. So what? You're estimating the expected return of the stock with respect to different risk factors. You identify relevant factors that influence the returns. That is what was the source studying, guys. That is what was the source studying. You are studying the different sources that are ultimately impacting the return for the stock. And you understand that these different sources, what is the sensitivity of my stock with respect to, by when I say stock, I mean security, whatever bond, everything is what I'm talking about. What is the sensitivity of my stock to those factors? There are 10 factors that are impacting a particular stock. My sensitivity as a stock to different factors might be different. I might be more sensitive to X factor, I might be less sensitive to Y factor, might be different from other stock. Let's say, for example, my stock is a consumer discretionary stock. Is what? A consumer discretionary stock. This stock will be impacted by different mac. अच्छा ठीक है चलो consumer discretionary you might not, I don't know if you guys understand or not. Let me just put it this way. My stock is an FMCG stock. FMCG stock is not impacted by the economic movements. That means economic movements is one of the factors that will influence the return for my stock, but not massively. That means sensitivity to the factor called as economic movements for my stock will be less. But let's talk about a company that is a luxury goods company. For that company, obviously, people will not spend in luxury when there's an economic downturn. So, obviously, for me, as a luxury goods company, economic movement is a massive factor, and I'll have be more sensitive to it. Why? Because economic movements will define the sales that I have, right? And there are usually two types of factors, macroeconomic factors. There is GDP growth, inflation, consumer confidence. And there are fundamental factors. There's earnings growth, firm size, R&D spending. And there are apart from that statistical factors also, which is, historical return data, data mining and stuff like that. Where you sort of, I mean, not data mining as in basically, you sort of use past to sort of predict the future. So a few statistical metrics that are used by you. But the problem here is data mining. Because if you use statistical factors are few statistical tools which ultimately explain your returns. If you use the statistical factors, there's a data mining risk. What is data mining risk? The risk that there might be a relationship just by chance. It is not explained by something which is making economic sense. Let's say, for example, every time Virat Kohli scores a century, it rains. There might be some coincidence in this. And if you sort of keep searching the data historically, you might find few instances. And you might think that, okay, that's great. That means there's a relation. So Virat Kohli scoring century, the one of the factors is raining. So if it rains, Virat Kohli will score a century. In the future, you will think that way. Uh, Sir, we have found a relationship between these two factors by using historical data, but it is because of data mining. Because we study a lot of data, so we just found a few coincidences. Okay. Is there economic sense to this? No. Economic sense relationships are example. Every time it rains, the stocks of two-wheelers do really well. Why? Because if it rains, rural areas do very well because the major income is agriculture. And if they do very well and they're earning, they will spend on two-wheelers because majority of the consumption of two-wheelers in our country comes from rural areas. That's where there's an economic relationship, right? And that makes sense, right? So return generating models are the models that help us calculate the expected return on the basis of specific factors. And one of them is right here. This is a multi-factor return generating model. What? Multi-factor return generating model. Okay, sir, we understood that return generating model explains to us the return of a particular stock, sorry, expected return of a particular stock with respect to specific factors. And we are talking about the stock, which is influenced by k number of factors. Factor number one, two, three, and till the point of k. Like by k, I mean like a random number, we're just considering k. Remember, I also told you guys what? I also told you guys that it also depends if a stock is affected by k number of factors, it also depends upon the sensitivity of the stock to those k factors. Higher the sensitivity to a particular factor, higher the influence of that factor in the expected return of that particular stock. Right. So expected return of this security above the risk-free rate. What? Above the risk-free rate. Above the risk-free rate. Is explained by these multiple factors, these multiple factors. It is explained by these multiple factors, factor 1, factor 2, factor k. So expected return that this factor is going to create, expected return that this factor is going to create, expected return that this factor is going to create will obviously influence the return for my stock. But understand, just getting the return from that particular factor is not enough. We also need to consider sensitivity, which is measured by beta. So I will consider the sensitivity as well. So my sensitivity to factor 1 is 0.5. So 0.5 into expected return of factor is 2%. And I will add all of these expected returns to ultimately give me what? The expected return for a particular stock above the risk-free rate. Right. And you know what? One of the factors is market risk premium. One of the factors is market risk premium, usually. Not in this case, but usually it is. Usually one of the risk factors is market risk premium, which is RM minus RF. Right. So usually the first factor is expected return on the market minus risk-free rate, which is the market risk premium. It is also one of the factors. So whatever market risk premium is, the expected return that you have, which is going to be with respect to the market risk premium into the sensitivity of a particular stock with respect to market risk premium, that becomes one of the factors in the multi-factor model that you are using to explain the returns over and above the risk-free rate of a particular stock. And there are few more models that are there, which are there. One of them is Pharma Fench, other one is Carhart model. Guys, you will understand all of these model in greater detail when you guys do your CFA level 2. Right? So don't worry there. Pharma Fench model is a three-factor model. I told you, no, a stock's return is explained by multiple factors. Now there were two guys, Pharma and French. These people researched and understood that there are three factors that explain the returns of the stocks. Those three factors are firm size, whether it is small cap, mid cap, large cap, book to market ratio, and market excess return. Market risk premium, now I told you it is one of the factors. They told that these are three factors. Now, is it necessary? No. But these are the two people who said that these are the three factors which influence the return of a particular stock. So you will calculate the return of a particular stock, which is the expected return of a particular stock over and above the risk-free rate in case of Pharma French model using three factors. Now you don't have to literally calculate, but you need to understand which are the three factors. And in Carhart factor, there is a fourth model which is called as momentum factor. Momentum factor means what is happening with respect to the prior period returns. Are the returns on upward trajectory? Are the returns on downward trajectory? What is happening with respect to the momentum of a particular stock? Right. That is what it is. Now, there is no defined thing to say how prior are we talking? 1 year, 2 year, don't worry about that. Just understand what do you mean by momentum as a factor. And the next one is a single factor model. Right? We understood one of the examples of multi-factor model, Pharma Fench. Carhart considers these three factors and a fourth factor, which is momentum. Now, there's also single factor model, which is your CAPM, guys. CAPM is what? Expected return on the stock, which is equal to risk-free rate plus beta into RM minus RF. And how are we calculating and how do we predict that what is the return that the stock is going to generate using the multi-factor models? Sir, we predict that what is going to be the excess return on the basis of multiple factors. If you rearrange this, you can do the same thing. C, expected return on the stock minus risk-free rate. That is the return that is generated by the stock over and above the risk-free rate is explained by one factor, which is going to be what? Market risk premium, which is RM minus RF. And obviously, you cannot directly take that return. You have to measure the sensitivity of that particular stock with respect to that particular factor. And that is what your CAPM is. The single factor model is a CAPM. There's another model which is called as market model, which is also a single index model, guys. Market model is also a single index model, which tells us that the return on a particular stock is given by the risk-free rate. Sorry, it is given by the alpha plus beta into RM plus the error term. What? It is telling us that the return on a particular stock can be predicted by this particular equation, which is alpha plus beta into Rm plus an error term. Sir, beta into Rm, what is that? We understand that. What is beta into Rm, guys? The return of a stock is influenced by beta into Rm. What is that? We have been doing this for a very long time. If the beta of a particular stock is 1.5, that means tomorrow if market goes up by 1%, my stock will go up by 1.5%. Market goes down by 1%, my stock will go down by 1.5%. If my beta is 0.5, that means if market goes up by 1%, my stock will go up by 0.5%. If market goes down by 1%, my stock will go down by 0.5%. I hope you guys understand this. So tomorrow, if the return on the market is 10% and my stock, what? My stock has a beta of 1.5. That means what is the expected return from my stock? 15%. Sir, then what is this? What is this? Alpha is what? The return that is not explained by beta into RM. Sir, meaning up until so far, we were assuming that our beta is 1.5 and the market return is 10%. That means my stock will give 15%. But my stock actually gave 18%. Okay. Sir, what was the reason for that extra 3%? That is the reason which comes from stock specific factors. Example, unsystematic risk. I anticipated that the stock will earn 15%, but it ended up earning 18% because of the unsystematic risk of the stock. The stock did so well and actually went up because of that extra 3% was generated. That is purely because of the stock specific factor. That is something that was not predicted by the market. That means alpha is what? Alpha is securities performance that was not predicted by the market, not explained by the market. And I need to incorporate that as well whenever I'm trying to predict how would the stock's return be by looking at the past trend. In the past, I have predicted for the stock the return as per the beta of the stock and the return on the market. But there have been a lot of instances where the stock has either outperformed or underperformed the market. It is because of the reasons that are not explained by the market. It can be because of stock specific reasons, unsystematic risk, which can be differing, which can differ from year to year. I have to incorporate that as well. And that is what is alpha. I hope you guys are understanding this. So then what is E? E is an error term which leaves the room for error. In the past, when I have predicted the stock's return by using these two factors, by using these two, not factors, I would not use the word factors here, by these two, what do you call, uh, by these two data points, if I were to put it simple way, it has been instances where there has been some error in predicting. Meaning we anticipated 18% by considering these two factors, but actually stock gave 20%. That means there was an error in predicting the stock's return by 2% in the past. Let us incorporate that error rate as well. And that is what is called as error term. And it can also be because of the unsystematic risk that is there. But I would not read too much into it. I would not try to understand or remember this via unsystematic risk component, because that will do what? That will confuse me even further. What I would try to remember this is as error term only. Just remember this as error term. That's all. And that is what your market model is. Guys, with me so far, understanding all the different models that we have done so far. Yes or no quickly in the chat box so that we can proceed further and understand the calculation of beta. And I'll be right with you guys. Just give me a minute. All right. Now let us understand how do you calculate beta. Sir, it is pretty simple to calculate beta. The formula is very simple. It is covariance of the security with the market divided by variance of the market. As simple as that. That is what beta is. Obviously, how this calculation is derived and all of those things, we will understand a little by looking at this graph. Sir, what do you mean by beta? Beta, if beta is 1.5, it talks about the movement of my stock's return with respect to market. So if market is going up by 1%, my stock will go up by 1.5%, fair enough. If market return is 50% and the risk-free rate is 8%, can I say market has over and above the risk-free rate given a return of 7%? And if my stock has beta of, or let me just put it this as 10%, the return on market is 10%. So over and above the return on market, risk-free rate market has given a return of 2%. My stock has given 15% and the risk-free rate is 8%. That is over and above the market. My stock has given how much? My stock has given 7%. And that also comes from the beta of 1.5 because 1.5 into 10 will give me 15%. And you know what beta is? Over the years, I will plot this. What this? The movement of my stock with respect to market in terms of over and above, in terms of returns over and above the risk-free rate. How much did market perform over and above risk-free rate? How much did I perform over and above the risk-free rate? Over the years, I will plot that data here on the graph, where I will on y-axis take the returns, which are the assets excess return of the asset over and above the risk-free rate over the years. I will plot market's excess return over and above the risk-free rate. So let's say for year 2010, this is where the return were for my stock with respect to return on market, right? With respect to in the year 2014, with respect to market, this is where my return of the stock was excess return. So I will plot all of these different points over the years, and I will draw a line that best fits or plots I mean, not best fit. I will draw a best fit line. I will draw a best fit lines that represents the entire data. So what do you mean by best fit line? Best fit line is a line that covers the maximum amount of the data that has been plotted. So out of everything, I will try to draw a straight line that covers the maximum possible plotting that I have done over the years with respect to excess returns. And that best fit line, which tries to cover majority of the points with respect to such plotting, that best fit line is called as security characteristic line. That best fit line is called as what? Security characteristic line. And the slope of such line is called as beta. And already we know this beta tries to measure the relationship with respect to movement of the stock. It tries to sort of measure the relationship with respect to the movement of the stock and the market. This is what it is doing. And the equation of this line, sorry, the slope of this line is going to be the formula for beta. Did I say equation? Sorry, my bad if I have said equation. The slope of this line is called as beta. Right. Now, sir, can I expand on this formula? Sir, beta is equal to covariance of security with the market divided by variance of the market. Sir, we do understand covariance of security with the market. It is given by the formula correlation between the security and the market into standard deviation of security divided by standard deviation of market. Sort of rewrite this. Covariance of security with the market is equal to correlation of security with the market into what's happening today. Just hold on. Yeah. Into standard deviation of security into standard deviation of market. If I substitute that here, what would I get, sir? I would get correlation of security with the market into standard deviation of security divided by standard deviation of market divided by variance of market. This and this cancelled. I will get correlation of security with the market divided by standard deviation of security divided by standard deviation of market. And that is how my formula would be placed. And you know what? You know what? This process that I just did, where I plotted the data with respect to the excess return of the stock and of the market with respect to, risk-free rate, the data that I've just plotted and the line that I just drew, this entire process is called as regression analysis. Where out of the data that was plotted, I draw a line that best describes the data, that best fits the data. Such a line is called as security characteristic line. And the slope of that line is measured by beta, which is covariance of security with the market divided by variance of the market. This process is called as regression analysis. whereby the dependent variable is the asset's excess return and independent variable is the market's excess return. And the slope of this regression line, the best fit line, is called as beta. And the steeper the line is of that security, higher will be the beta, because steeper the line, higher the slope, and slope is measured by beta. Or beta is measured by slope. Right? If beta is equal to 1, asset moves in line with the market. Greater than 1, asset is more volatile than market. Less than 1, asset is less volatile than market. And less than 0, asset is inversely related to the market. That means if the beta is negative, right? And that is what this entire calculation with respect to beta is. All right. So what all have we learned so far? What all lines have we learned? Sir, we understand Cal. Cal forms the base of the line called as CML. CML has the market portfolio. That is why it is called as capital market line. Sir, market portfolio, why is that called as market portfolio? Because majority people will invest there. Why? Because it is lying on the efficient frontier. Okay. And because homogeneous expectations are there. Sir, we understand securities characteristic line. Okay, fair enough. Because it talks about beta and it is regression. Sir, now what is securities market line? What securities market line or security market line? So what does that mean? What do you mean by security market line? What do you mean by security market line? It is nothing but a graphical representation of CAPM, guys. And I will try to prove that to you in some time. In the next 10 minutes, you will know that why SML is the graphical representation of CAPM. But let us plot SML. As usual, on y-axis, we will take expected return, but in security market line, on x-axis, we'll take systematic risk. Remember, guys, standard deviation is equal to what? Standard deviation is equal to what? Systematic risk plus unsystematic risk. Up until now, we were taking standard deviation completely. Now we will only and only take systematic risk. We will ignore unsystematic risk, and everything else remains the same. SML plots the different combinations of what? A market portfolio and a risk-free asset portfolio with respect to weights. Everything else remains the same. Everything else remains the same. Only thing is that you are plotting here systematic risk. And systematic risk here is given by covariance of the security with the market. And this is the point which is called as market portfolio. And if you plot it on the risk basis, systematic risk here is given by. Now, one thing that I would want you guys to remember. Now, this is a revision lecture and I would not want to get into the detail of it. Here they have plotted systematic risk like this. They have written systematic risk like this. Covariance of security with the market. If you guys don't know the logic of it, remember it like that. That here in SML, what? Here in SML, remember it like that, that here they have plotted the systematic risk, which is the risk on, which is the risk on basically your x-axis. It is plotted as covariance of the security with the market, right? Okay, sir, fair enough. All right. Now, this is the market portfolio. Sir, we understand how market portfolios originated. Sir, this was the efficient frontier. This is my efficient frontier. This is the portfolio that was tangent. We took a market portfolio, right? Now, as per the indifference curve of a particular investor, it will depend upon where he would be on the securities market line. That would all be the same. No difference. But the point is, this is the market portfolio. And at this point, we are talking about the systematic risk of a market portfolio. And how is systematic risk presented here? Sir, it is covariance of the security with the market. Sir, this time the security is the market portfolio. So covariance of the market portfolio with the market. Covariance of something with itself is the variance of that particular thing. Covariance of something with itself is ultimately variance only. That means covariance of security A and B. That is the correlation between that ultimately will get you to correlation. Okay, so fair enough. That means we're talking about some sort of relationship in covariance between A and B. We have understood that in the previous lecture, but I sort of repeating it. Covariance of something with itself. That means covariance of A with A is ultimately variance only, right? That is what it is. It shows the asset's expected return with its systematic risk. And you know what? And you know what, guys? Just hold on for a second, guys. Just hold on for a second. A minute. Yes, right. And remember, SML is relevant for individual assets. That is one more difference as opposed to capital market line. It is more relevant for individual assets, right? Sir, we have plotted your market portfolio, but it is relevant for more individual assets? Yes. Now again, one thing that I would want you to just remember. And it is also the only pricing uses systematic risk, and it is presented by systematic risk is given by covariance between the security and the market, right? Higher the covariance, obviously higher will be the systematic risk and higher the required return. Higher the risk, higher the return. And the equation of this line is nothing but what? Is nothing but CAPM equation. This line, the equation is given by what? It is given by risk-free rate plus expected return on the market minus the risk-free rate divided by will be the risk-free rate plus the expected return on the market. Because we're talking about the market portfolio here minus RF divided by the variance of the market into the covariance of security with the market. And now you can plot the whole thing. And when you sort of, you know that the covariance of something with itself, you sort of write the equation, expand the equation of that, then you simplify the whole thing. You will get nothing but the security plus beta into RM minus RF. This is what you will get when you simplify this particular equation. So how do we simplify the covariance of securities with the market? Substitute that with what? It is going to be the correlation of security with the market into standard deviation of security divided by standard deviation of market. Right? That is what it would be. And again, this is nothing but the equation of a line, guys. Y is equal to AX plus B, right? Where intercept, slope, all of those things, same thing. But just one thing remember. One thing you remember, guys. What? Guys, SML is for individual securities, whereas CML is for portfolios. Sir, how come here market portfolio is pointed out then? That's something that this individual securities, that is something that I would want you guys to remember. Anything that comes above SML is undervalued and below SML is overvalued. Sir, how are we saying that? How are we saying that? Pretty simple. If it is at this point, for this risk, you are getting this amount of return. And for the same risk, you're getting this amount of return. That means this security is undervalued and this security is overvalued. And anything that plots on SML is appropriately valued. Again, remember that. right? Anything that is plotted on SML is appropriately valued. Above SML is overvalued and below SML is undervalued for the reasons that I have just discussed with you guys. All right. And there are a few assumptions with respect to CAPM. Everyone is risk averse. Everyone is utility maximizing. There are frictionless markets. There are no taxes, no transaction costs, no impediments to trading. Everyone has one period horizon. That means everyone only invest for 1 year, right? Homogeneous expectation. They have identical estimates for expected return, standard deviation, correlation. They have the same efficient frontier of sorts, basically. Divisible assets. That means all assets are infinitely divisible. That means if I have to buy 1.75 share, I can buy 1.75 share. If I have to buy 2.22 shares, I can buy 2.22 shares. If I have to buy, 33% of the land, I can, stuff like that, everything is, and the markets are competitive. That means prices are taken as given. No influence, no single investor can influence the prices. Basically, you're a price taker and not a price maker or a giver, right? And let us start to compare CML and SML. Sir, we understand what do you mean by CML. Actually, you know what? I would want to take you guys to Schwezer for this. Sir, in CML, what were we using? In CML, we were using the total risk. In SML, what do we do? Sorry, in SML, what do we do? In SML, we use what? In SML, we use only systematic risk. And you can see right here, CML is plotted and SML is plotted. You can see right here, CML is plotted and SML is plotted. In CML, you can see total risk is used. In SML, you can see systematic risk is used. Everything else remains the same. Y-axis expected return. A risk-free asset at this point, risk-free asset at this point. This is the market portfolio where beta is equal to 1. This is the market portfolio where the standard deviation of market portfolio is right here. Market portfolio, market portfolio. Right, same thing. This is also the one that is tangent in the efficient frontier. ये क्या है आपका efficient frontier? This is your efficient frontier. Right. That is what this is. Now, if you go beyond this point, obviously you're borrowing money and investing. If you go beyond this point, obviously you're borrowing money and investing. What are these portfolios? Borrowed portfolios, right? Okay, sir, everything remains the same. Now let us try to understand these different points that are there. A, B, C, E, D. Sir, D, we understand that this is a point where some money is invested in market portfolio, some money is invested in risk-free portfolio. Okay. Sir, A, B, and C, sir, what are these points? These are inefficient portfolios. Why? Because they lie, first things first, below the efficient frontier. Right. So A is an inefficient portfolio, C is an inefficient portfolio. But there is one thing. There is one thing. What? You can see right here, portfolio B, which is even if below the efficient frontier, this is the risk that you are facing with portfolio B. This is the risk that you are facing with portfolio M, which is the market portfolio. But the return is the same. The expected return is the same. The expected return of portfolio M, which is the market portfolio, and B is the same, but the risk of B is much more. And you know where does that risk come from? That risk comes primarily from unsystematic risk. Because you have taken more unsystematic risk in portfolio B, that's why your portfolio is somewhere facing more risk. But market portfolio is a portfolio that is completely diversified. There is no unsystematic risk that is there. That means there beta is equal to 1. And you know what? With this portfolio B, the beta is equal to 1 as well, because beta is a measure of systematic risk. It doesn't measure total risk, it measures only systematic risk. And here at portfolio B, your systematic risk is more is similar to what is in the market. Your total risk is more because in portfolio B, you've taken a lot more unsystematic risk. Right. That is what they're trying to tell us. And A, obviously, if the beta here, obviously the beta of market portfolio is 1. If A is above that, the beta is high. If C is below this, beta is low. And understand, just because C has a lower beta, that doesn't mean that C is a very, very good security with respect to, adding them with respect to the risk point of view. How come? Example right here. A firm whose only activity is developing a new but yet unproven drug may be quite speculative with highly uncertain returns. It may be very low with systematic risk. Their systematic risk is very low, boss. Beta is less than 1. That means systematic risk is low, but the total risk might be high because of unsystematic risk component. Because this company is developing a drug which is not yet proven and has not yet gotten any sort of approval. Tomorrow, if it gets approval, the return will skyrocket. Tomorrow, if it doesn't get approval, everything will tank. But the point is the return of the stock depends upon firm specific factors that makes it risky. Just because it has a lower beta, that doesn't mean that it has lower risk. That is what the interpretation is. Sir, we don't understand, sir. You have sort of assumed a lot of things and told us. Guys, whatever I've told you, just remember that that's all. अगर नहीं याद हो रहा है, understand this logically the way I have explained, nothing else. I don't have the time, unfortunately, to tell you that, how do you plot A by beta is equal to 1 for, B exactly. No. You'll have to sort of understand this that A, B, and market portfolio is given the same expected return. That means their beta would be the same. The only reason B has total risk is because higher total risk is because of unsystematic risk. Understand it in that. All right. And if you can see securities market line, everything that plots on securities market line, security E, A, B, D, C, everyone is priced, is appropriately valued. If it is valued over and above this inappropriately, that means it is undervalued, not, and if it is below, that means it is overvalued. An example of thing so that you can understand this fact completely. A portfolio contains information based on analyst forecast for three stocks. There are stock A, the stock B, and the stock C. The price today is this. The price that is expected in 1 year is this. The dividend that is expected in 1 year is this. And the beta of a particular stock is this. Right. So the following three figure contains information based on analysts' forecast for three stocks. Assume a risk-free rate of 7% and return on market of 15%. Calculate the expected return and the required return on the stock. Right. Determine whether each stock is undervalued, overvalued, or property valued or properly valued. What do you mean by required return? Required return is given by CAPM. Expected return, what we are expecting. We are expecting a price movement of this particular stock to increase by 2 rupees and also dividend of 1 rupees. That means a total return of 3 rupees on a base of 25. This is what we are expecting. As per CAPM, which is equal to beta into RM minus RF plus risk-free rate, this is the return that is required for this particular stock. If the required return is more than the expected return which the stock might deliver, that means the stock is overvalued. If the required return is lower than the expected return of the stock, that means the stock is undervalued. And if it is the same, the stock is appropriately valued. Stock number A, here the return, which is the forecasted return, which is the expected return, is 12%, whereas the required return is 15%. That means the stock is overvalued. Here the expected return is what? 17.5, whereas the required return is 13.5, 13.4. That means the stock is undervalued. And stock C is appropriately valued. What are the strategies that you would use? Obviously, sir, we will short sell stock A. We will, because stock B is undervalued, we'll buy that. And with stock C, it is properly valued, so we can buy, sell whatever you want, we can do. And you know what? Stock C, which is appropriately valued, will plot exactly on SML. A, B, which is undervalued, will go up, and A, which is overvalued, will go down. The SML. And that is what the explanation is given right here. And the last bit, which is with respect to ratios, a very, very simple bit. Again, whatever I'm telling you guys, that's all you're supposed to remember. These are the four simple formulas with respect to your ratios. Sir, what do you mean by Sharpe ratio? Sharpe ratio simply is what? Sharpe ratio is simply what? The return that I'm getting over and above risk-free rate per unit of the risk that I'm taking with respect to the portfolio. What? The return that I'm getting in the portfolio over and above the risk-free rate. Over and above what? The risk-free rate for every unit of risk that I'm taking in the portfolio. That means expected return on the portfolio minus the risk-free rate divided by the standard deviation of the portfolio. For every 1 unit of risk that I take, what is the extra return that I get over and above the risk-free rate? It can be ex ante. That means if you are using what expected return, it can be ex ante, it can be ex post. If you are using the actual return of the portfolio, that means it is ex post. It is actually after what the return of the stock has delivered or a portfolio has delivered. And that is what your Sharpe ratio is. Sir, what do you mean by M squared ratio? It converts the Sharpe ratio into something which is called as a risk adjusted return in a percentage form. Meaning, sir, M square is simply risk free rate plus the standard deviation of the market divided by standard deviation of the portfolio into return on the portfolio minus the risk free rate. You can clearly see here the Sharpe rate has been adjusted by considering risk. And here, obviously, we're talking in terms of percentage, right? That is what this is. Sir, what is tenor? Tenor is pretty simple. Sir, it is exactly like Sharpe, where you take expected return on the portfolio minus risk rate. But in Sharpe, we are taking standard deviation of portfolio. Here we will take what? Here we will take the systematic risk. That means the return that I'm generating over and above the risk-free rate per unit of systematic risk that I'm taking. And obviously, this is best for something which is a well-diversified portfolio. Guys, I've not included the diagram bit here. I hope you guys understand. This will be more from SML because it talks about systematic risk. This will be more from CML because it talks about total risk CML and CAL, right? And why would this give things to us in percentage forms? So if you don't understand this, what I've just explained to you in terms of the formula, try and do a question of this. You will understand that you will get answer in percentage terms. And sir, what do you mean by Jensen's alpha? Jensen's alpha is a return that is above the CAPM prediction. CAPM predicted 15%. If you got more than that, that means you have earned more return. That means a return of the portfolio minus the return that was estimated by the CAPM, which is what? Risk-free rate plus beta into RM minus RF. And that wraps up our complete revision of portfolio risk and return part 2. Has everyone understood everything, whatever I have told you guys? Yes or no? Quickly in the chat box so that I can wrap up the revision for the day and I can leave you guys. All right. Perfect. I'll stop for the day, guys. Thank you so much. Bye bye. And I'll see you guys soon with another revision which is left with respect to our FSA.